Well, good afternoon, everybody, and thank you for tuning in to the monthly market monitor. As you can see from the second to the bottom line there, if you have any questions during the presentation, please pop them in the Q&A chat at the bar on the top of the screen or the regular chat, and I will address the questions at the end of the presentation if anything does come up during the slide deck. So go ahead and get started. First, with labor update. Interesting, again, the definition of unemployed it tends to elude a lot of people in the marketplace. But why did it go up when the labor market has been so strong? But it's up in part because the definition of unemployed includes people actively seeking employment. So what we've seen recently is some of the local and domestic matching funds for unemployment insurance compensation have expired, and the slow return to work as people start seeking work again kind of turns the unemployment number up. The U6, the so-called underemployment number, that was 7% also up. So what we saw in the last couple reporting periods are actually full-time job holders seeking a second job to make ends meet. So again, there's an inflation metric that's kind of embedded in the data that maybe gets overlooked a little bit, that the part-time jobs added were actually from currently full-time employed people or people with multiple part-time jobs driving the numbers. So, but both indexes are up. But again, it's historically speaking a very strong labor market from an unemployment numbers perspective, and just net numbers. But it's something to bear in mind as we proceed into the next couple of years as to the composition of those metrics and what actually drives that data. The employment cost index, you can see, is starting to turn over a little bit. So it's much more, I guess, robust than it was previously. And you see that the numbers have turned over. In other words, they're down from their peak. And so we have a little work to do yet to get down to the 2%. I know this is an employment cost index, not necessarily the CPI, the inflation metric, the target numbers that the Fed uses to position all of their monetary policy. But anyway, it does show that it has peaked, it's come off, and is headed back into a direction where it might be affordable. Other thing that underpins a lot of the consensus of those who think a soft landing is imminent after all the stimulus and the potential recession we have in 2024, there's still 3 million more job openings than there are unemployed persons. So again, a skills mismatch. Maybe it's definitions on who's able-bodied. The boomers are retiring, so there is a demographic shift occurring. I know we've heard a lot about the boomers retiring, and it was delayed, by the crisis way back in 08, 09. And then they started working again and stayed in place, and COVID pushed a lot away. But there is that, what they call the employment gap on senior managers. There aren't enough Generation Xers to fill their shoes. So a lot of them have been compelled to stay or convinced to stay through payments or working terms, whatever it is. But still, this does show a demographic shift in the employment picture, and maybe more reliance on AI as we proceed. And with the service industries like restaurants, hotels, etc., it's getting more and more. I don't know if any of you travel frequently. I don't anymore, but I did travel recently and noticed that it's kind of more of a do-it-yourself type thing. The valet service and the baggage service isn't what it was, and you're typically, even at the high-end hotels, etc., expected you just do it yourself because they don't have the personnel internally to handle it. Like we mentioned on the employment cost index number, you can see the headline PCE, the personal consumption expenditure, which is the Fed's preferred metric for measuring inflation pressures, and the headline consumer price index. You can see the black line is where we are now, and the forecasts are. One interesting note that the Fed governors talked about when they started the rate hike cycle, after the 25 basis point hike, then they started raising 75 at a time. So much more onerous and much more drastic hikes. They talked that getting inflation from 8 to 4% will be easier than taking it from 4 to 2%. So that's kind of the area we're at right now. Give or take 3.5%, 4%, depending on whatever metric you're using to measure it. But we're at that point now. And the risk, there's a lot of political risk, unfortunately, with this. It's not just an economic metric anymore. With the war in the Middle East, If Iran's gets some expansion in the war and oil prices go up sharply, there is a scenario that's not zero chance of happening, that oil price doubles in a month or two. If there's some sort of attack, or they close the Straits of Hormuz, or they close the Suez Canal, that could be a major disruption in the economic engine that drives most of the economies in the world, which is petroleum. So that is something to bear in mind, that this could all go really haywire, and that forecast could be just pretend, if we see a spike in energy prices in the next several months. Commercial real estate, and you can see all the subgroups included here: apartment, retail, industrial, etc. I guess the point I want to make sure everybody takes away from this is that it's turned over. So it looks like the worst is behind us, and every metric is headed back down to whatever normal is, whatever normal means. And we are headed in the right direction, but still have a long way to go to get back there again. But commercial real estate, again, is a sector that many economists believe will lead to the next kind of major correction in prices. Since COVID happened, New York City, Los Angeles, San Francisco, Boston, Chicago, all the usual suspects have really kind of gone back to remote work. The employees there have gone to remote work, and they're not returning to the office. Ergo, the rents aren't what they should be. They aren't what they commanded pre-crisis. So there's a whole restructuring in that sector. And most of that paper is held by your regional banks, your mid-market banks, not your big, JP Morgan and Wells, et cetera. It's more of your regional providers who have exposure in that sector. So, and unfortunately, if there is a major correction, it's going to cause a lot of losses in that mid-market tier, and effectively make the bigger. So there is a scenario that exists that perhaps Wells and JP Morgan could grow market share, despite the fallout in the commercial real estate market. Again, the turnover here, median prices of single-family homes sold, you can see it drop from the peak, but it's still well above the pre-COVID numbers. And if you kind of just interpolate from 2020 until now and take out the anomaly of COVID and all the rest of it, it's still on a higher slope up than it was previously. So I think this number has a little more correcting to do yet. I saw it turn around and reverted back down again. There was a big spike in refinances that you probably saw in the last week or two, with the 10-year yields dropping, from over 5 to 4.5% in a couple of weeks. So again, the 10-year pretty much drives 30-year mortgage rates. So again, they're higher than they were, but they're lower than they are, if that makes any sense. So anybody on the sidelines probably went and secured financing as quickly as they could, and it drove a little bit of volume in mortgage originations. But the houses being sold are priced down, but including the interest rates, that their monthly payment are probably comparable what they were, before the crisis and before all the run up in inflation. This is also another metric that drives the needle a lot on consumer prices. You can see that the used vehicle numbers have come down pretty precipitously as well. We averted, the strike, the General Motors, the big three, UAW strike. They did manage to get deals done between management and the unions, and they're back to work again. So there was already increasing inventories in most domestic producers. So we didn't see a massive precipitous spike in new car values at all. And that's what the one risk to the used market was, is that if there's no supply of new cars, that used cars go up in price. But it didn't happen this time. There was enough hangover in inventory that it didn't result in a big change in used car prices. And that's a good thing, at least from the perspective of getting inflation continuing towards 2% target. You can see these are the types of cars. Only pickup trucks are up notionally in small values year over year. The biggest ones, compact cars, again, that are down in price. And maybe with the oil prices coming down a bit the last couple of months, we're down to about $3 a gallon in Milwaukee, give or take. So that's cheaper than it was, in some of the recent months anyway. So it might be driving some of this as well, along with just returning supply chains to quote normal and inventories back to quote normal. The next couple of slides are really just kind of, I think, are interesting trends that we're seeing in the marketplace. And this is consumer spending, again, in trillions of dollars. It's set in 2017 dollars. So again, it's seasonally adjusted, but $17 is kind of before all the COVID stuff and all the funny money, etc. You can see the red line there with COVID and returning back to the pretty much the slope line. But again, consumer spending still exceeds the growth rate and the trend line going back to 2014. And again, consumer spending does account for 69% of GDP, at least it did in quarter three. So again, the U.S. consumer is the most resilient consumer in the world, and we drive a lot of activity, in the marketplace, in economics, and durable goods, and all the things that drive the global economy. As we import a lot of goods here, export a lot as well, but the U.S. economy is really the bellwether, not the bellwether, but the benchmark for anybody in the world globally. Anybody wants market share in the U.S. because of our consumer power, and we can leverage credit. Again, that's good and bad, as we all know. I saw an article today on the credit card debt being the highest ever, and it repeats a month ago when it was the highest ever. So it is seemingly continuing on the trend of unsustainability, whatever that means. Consumer debt based on your income, real wages, etc. So eventually there's going to be a correction, but so far it looks like the consumer is keeping up and actually dragging above the trend line going back to 2014. So it's almost 10-year trend line on this particular chart. Again, struggling for car payments, subprime debt. Again, when I worked in the auto industry 100 years ago, when you got to a 5% delinquency number, it was like, Houston, we have a problem type stuff from Apollo 13. 6% we are at now. And this goes all the way back to 1994, since we had the last 6% metric on delinquency. Again, this is 60 plus delinquents on subprime loans. So it's a subcategory of a subcategory. And maybe in 94, we didn't have quite the market of subprime lenders we have now. Maybe more people put more money down and didn't do, 10% down 84 months on a used car like they do now. So again, the market has changed. I want to kind of consider that as well as we look at these numbers going back to 94. But the takeaway I want you to have is that 6% delinquency is not a good sign. And the other bad sign about this is that many of these loans are originated in 2020 and 2021 when rates were at decades low levels. So going back to 94 or even 2007, in the era that led up to the housing crisis, a high rate environment, when you have a portfolio that earns 7% and you have high delinquency and take some charge offs, that's a punch you can maybe take. But when your portfolio is earning 3%, those losses are really, really hard to realize without tanking your entire portfolio. So the other risk is the yield on those loan portfolios originated in 20 and 2021, and now the chronic delinquency in the softening secondary market, as shown by used cars. It could be some correction territory coming here in that sector. We hope it doesn't happen, but it's something to be cognizant of definitely as we proceed into 2024. Again, this is a chart that we kind of live by here at Corporate Central. We typically buy ABS, prime ABS. We do not buy subprime. And this is really kind of why. In times of volatility, prime stands up. They stand up and they don't really have real volatility and major losses that happen quickly and suddenly. So you can see here how volatile subprime is going back to 06 versus prime. And prime is just steady Eddie, pretty consistent cash flows. In an auto portfolio, 5-year, the average life is 2 or 3 years. So it's a portfolio that can turn over pretty quick as well. So again, the prime lending is just a sector where you kind of live and count the good times when they're good. But in subprime, spreads are wider. But man, the volatility, you certainly better make sure you're getting your price to risk ratios considered are right when you do your pricing metrics. This is another interesting chart, I think, here. Credit card and auto loan balances on the left side. You can see here are the percent of the highest numbers that we've had in a long time. And then each of the demographics, 18 to 29 in the red being most noteworthy. You can see how delinquent that class is versus all their peers. Interestingly, the 60 to 69 is the second highest. But again, they've come off, fixed income pricing. and the inflation's eaten all their savings bonds away. Hardly anybody has savings bonds in the demographic of the natural person deposits, other than folks above 55. So not many 20-year-olds with a CD out there. So now they're getting paid a little bit on that cash since rates are up. So perhaps this rebounds, but I think it's an interesting a dynamic and measurement of delinquencies going back to 2012 for each of those ages and the historical trends and the spreads, how much higher they are now relative to the other classes with some economic stress in the marketplace. Bank lending conditions have also tightened. You can see C&I, which is construction and industrial and commercial real estate. So this is percent banks who think they're tightening standards. So 50 and 75% are tightening their underwriting standards in commercial real estate and construction and industrial. Again, this really drives the economy very, very much with C&I, for example, and that's roofers and people hanging drywall and all the rest of it. So that type of industry, if there's a tightening in lending, there's less opportunity to do work, and it slows the economy, and GDP may suffer. And again, banks' willingness to lend to consumers, you can see that's now they're on the tightening side and the caution side. And from banks' perspective and credit unions and everybody who has cash, there is not a great return, but 5%, 5 and change percent on cash, which beats mortgage loans from 2 years ago. So I mean, until you get the relative benchmarking and spread to your cost of funds, and are you hedged and all that boring stuff that money managers do, it might take some reluctance for people to extend again, especially into an inverted curve. But again, that has flattened a little bit, and we'll see where we go from here as the Fed policy action proceeds into 2024. GDP again came up annualized rate of 4.9% Q3 to Q2. And you can see, the red lines going back here, different recessions over the past, looks like about 18 or 20 years. And the surprise to the upside in the last GDP print, again, consumer spending had a lot to do with that driving. We saw those metrics a couple of slides ago. But with the commercial real estate, the softening in lending, the pervasive delinquency in subprime, that could change in a hurry. I hope it doesn't, but it's something to be cognizant of as you go into 2024. The Chicago Purchase Money Index, again, down for the 14th consecutive month. So again, that is a big needle mover. Purchase Money Index, inflation, cost, employment cost, it's all embedded in this particular chart. And you see it's been down for 14 months straight. So there are many headwinds in this economy right now. So I'm hoping for something positive, but with the global war out there, I mean, there are certainly a lot more danger zones and events that could precipitously change the outlook in a hurry than there were a year ago or so. So it's kind of uncharted territory. I know it's a cliche you hear a lot, but it really is interesting times that we're having now, given the debt burden globally, not just the U.S., but globally. The European Central Bank, the Bank of Japan, they all have the same pervasive debt issue that we have. So we're not alone. I guess that's the good news. Unrealized losses, again, on securities at commercial banks and billions. You can see we're off the peak numbers. Again, the portfolios are shortening and rates, are up a bit. I know they were down the last couple of weeks, but again, when rates are up, again, when you buy an asset and rates go up, you lose value. So this has a lot to do with the portfolio shortening as well. And maybe the correction in yields we've had the last couple of weeks, how they're back again 40 basis points. That would certainly help mitigate some unrealized losses. But certainly this is a very, very big number. And to remind everybody, this is the reason why the U101, the so-called bank term funding facility, was added in the first place, to allow companies to post government-backed collateral at par value and borrow against it at par value. So essentially mitigating the unrealized gain loss you have on the sale of the asset, you can post as collateral and borrow at par. And again, that happened in the wake of the Silicon Valley Bank bankruptcy that we had, or failure we had earlier in the year. You can see the Fed's balance sheet going back to May of 2021. So we've been in this QE portfolio thing for a long, long time. And again, the Fed reducing its balance sheet is probably a good thing, given the massive balance sheet that they had and the assets that they have on balance sheet. They originated those, again, like the subprime auto lenders did in 2020, 2021, even before that. So they own 30-year mortgages with a 2 handle on it. And current market is, 6 and 7 handle on it. So they're 4% underwater on their portfolio, and they're funding it with cash. And that's one thing to bear in mind with the Fed, is that they made money for a while on the portfolio, and now they are losing big time. So the offsetting income they have for being there and providing the liquidity and all that is gone now, and it's a negative ARB every time they do it now, given their holdings in the portfolio. So this running off is a good sign from that perspective, but still, the unrealized gain loss on the Fed's balance sheet is massive. WeWork. This is a company that a lot of people don't really understand what it means or what they do exactly. But WeWork, you see, they merged back with SBAC in 2021. But WeWork is a company that goes in and leases, industrial space and office space in big cities, San Francisco, New York, to name a couple. And then small companies that don't want the legacy risk of having that big of a rent payment on, and they want, a couple conferences for, Tuesdays and Wednesdays. So they pretty much like job share smaller companies and do all the maintenance, and they take care of the leases. But as you can see from COVID, people left and didn't come back again. So they filed Chapter 11 bankruptcy, which again is reorganization bankruptcy, not liquidation bankruptcy. So they're saying that their leases are unfair because they were negotiated at a time when people actually sought to be in an office in downtown San Francisco, downtown New York City, etc. Now it's completely changed. So there are people who think that it's an investment now, even though they're pretty much bankrupt and lost almost 100% of their value in 2 years. If the judges agree with their bankruptcy petition to renegotiate the lease terms, it might be a viable business going forward, but certainly not at the expense multiples they're in right now. So again, it's indicative of this new, almost like an 1870s style in reverse. When rural areas went to cities, it might be a reverting back to the old way, leaving big cities and just forming companies in more affordable real estate areas. This is another one I thought was really interesting, given all the volatility in the oil market the last year or so. Crude exports have actually gone up. This is U.S. crude exports only. So we had the correction in rates in light sweet crude prices. They're up a little bit lately since the war started in the Middle East, but still, $3 a gallon. In the context of what we had a year or so ago, when it was $5+ a gallon for gas, it has been cheap. So we are exporting oil mainly to the European side. So it might be to give them a little more confidence in supply chains, given the war in Ukraine that preceded the war in the Middle East. Again, Ukraine and Russia are big commodities exporters, and the pipelines, etc., are at risk of being attacked. So leads to higher prices there. But I thought this was an interesting data point that we actually have increased exports in the U.S. for crude oil this year. This last one too, I just threw this in there. It's kind of off the run, but all the talk about decoupling from the US dollar on international payments. This kind of gives you a little bit of scale on a 10-year change. You can see in the middle of your screen, that gray outline, that's China. So yes, they have doubled their market share, but it is completely insignificant compared to the US market share, who also gained over the same period. So again, this does show that confidence internationally in the U.S. dollar's economy, U.S. dollar and the capital markets in the U.S. and the trading platforms we have here, and the so-called BRICS, the Brazil, Russia, Indonesia, China, and all these people want to peel off and create their own currency. China is 5th on this list, behind Japan. So even aggregating all those countries I mentioned, it's still probably barely above what Japan's market share is. So this put me at ease a little bit. I didn't realize that their market share was this low relative to the US and the euro. Again, the euro is dropping market share, but the US is gaining. And it doesn't look like this is going to change anytime soon. So rest assured, the petrodollar is probably safe for another couple of years at least. Last couple slides here is just the rates moved. This is month over month. You can see there's been a pushback in yields the last several weeks. Again, 10-year did hit 5% for a while there, and now traded back down to 452. So it has corrected very significantly in the last month. This is the so-called WIRP, the futures market, on what they expect the Fed's path to be at the next couple of Fed meetings. I can tell you that 2 weeks ago, there was about a 60% chance of another hike built in between now and January. Since the last couple economic meetings and maybe the fear with the international wars and maybe inflation prints coming down, approaching 2 again, lower than 4 and headed the right direction. Maybe we topped off with the CPI numbers we talked about earlier. There is no hike built in now, and in fact, that cut is built in June of 2024. That 109 means 100% built in for a cut in June. But again, this could all change tomorrow, so don't go and budget off this number. This is very volatile metric, and it changes with the wind. But this is printed today, and it does show the bias is down on the Fed rate path and that they have peaked. But again, this is one benchmark of many. So don't go to town and think, oh, rates are headed down. They might not. They might stay where they are. But the futures market does have the Fed's path as done and down from here. When is the question? 2-year Treasury yield, again, we saw the peak. It has come down from peak, but it's still trading close to 5%. 10-year Treasury yield, this is the one that's driving the 30-year mortgage rates and how they're down recently to maybe driving some of that refi volume. But it did flirt with 5%, but you see it has corrected significantly just in the past couple of weeks. Again, this is just a generic. I pulled the CUSIP off so no one knows what it is, but this is a new production 5.5 coupon 15-year. You can see what the yields are on these and just the base case Bloomberg median prepayment assumptions. And again, close to par. A lot of times they'll sell you a low coupon, a high coupon. If the rates are going to do this, you should buy the low coupon, a high coupon that. But I'll take all the analytics out of it and all the noise out of it, and about par what you can yield. And again, you have your different prepayment assumptions in your weighted average life. It goes from 5.5 to 6 years, pretty much. The down rate scenarios, again, 5.6% for a 4-year average life. Same on the 30-year. This is a 6 coupon. You can buy a 6 coupon at a slight discount. So again, it makes sense, 6% yield, but 8, 9, 10%, 10-year average lives. And again, these rates with a 6 coupon are probably, 7 something on the wax. So this could be really risky on prepayments if rates do drop 1 or 2%, because these are very rate sensitive loans in 30-year pools. So, but again, it's just some color as to where they're about trading on new production. And that concludes today's Market Monitor. I don't see any questions in the chat or the Q&A. If there are any, please type now and I can answer them. Okay, looks like no activity. Okay, thank you all very much for joining this month's Market Monitor. We'll see you around Christmas time next month. Have a great week.